The UK is looking at the highest inflation in the G7 forecast. Netflix is teaming up with a beer giant. Disney Plus just got more expensive, and TikTok's somehow only worth $14 billion in the newest deal information released this week. You're listening to the Media Intelligence Podcast from WPP Media. I'm Kate Scott Dawkins with Jeff Foster and Nidhi Shah from the Business Intelligence team, and each week we unpack the biggest stories in media and marketing and why they matter for brands. So we have to start briefly with TikTok. I mean, we've spent so much time talking about this ban and the saga around it, but let's just quickly touch on some new information. We still don't have all the information. Some new information we got yesterday from the executive order from the U.S. White House, TikTok deal-ish. So the biggest update to me was the valuation at just $14 billion versus what analysts apparently, according to Bloomberg, were expecting closer to 35 or 40. And that makes sense given last week we shared, revenue is likely to be over $13 billion this year in just the U.S. So what does a 1x revenue multiple say for a high growth company like TikTok?
Yeah, I think that kind of came as a bit of surprise as these more stories and reports started coming out. But yeah, I don't know. It's still hard to process everything without seeing all the details. We're getting more and more reports of revenue and profit splits and sharing that sounds fairly complicated. So I think until we see everything, it's just very hard to kind of wrap your head around this.
Yeah, we're still missing some details on the treatment of the algorithm in particular. We'll probably still be talking about this 6 months from now. So, yeah, definitely check out news on that. I think for advertisers, there's at least a semblance of security in being able to continue advertising. There's a new 120-day ban on enforcement of any sort of, TikTok use. So it feels more and more secure as we go through, even though there are still a lot of unanswered questions. All right, well, from TikTok on to European economic news. Nidhi, welcome back. How was your vacation? We were certainly a little bit more tilted toward U.S. stories the last 2 weeks.
Yeah, it was good. Glad to be back and up and running with some of the economic data for Europe and the UK. So some signs of slowdown, particularly relative to the kind of first beginning of the year, particularly in terms of interest rates. Both the ECB and the Bank of England have held their interest rates unchanged in the latest meetings, which signals a bit of a mixed reaction, really. Because on one hand, you've got inflation, which has been stable for the euro area at 2%. And it's actually come down relative to last year, which is good. But for the UK, that's looking quite different, with recent inflation data suggesting that there's been a steady uptick. So maybe the consumer feeling a little bit more pinch, especially in terms of food prices and fuel. And this week as well, we had OECD forecasts suggesting that UK inflation for this year is going to be amongst the highest within the G7 nations and higher than the euro area. But I know they also mentioned about real GDP growth being slightly faster this year. So particularly relative to like the euro area and markets such as France and Germany, which concurs with kind of our advertising forecasts, where we've got UK at 6.5%. But Kate, Jeff, how does the US and other markets fit into this kind of picture? I know US inflation is expected to be, according to the OECD forecast, tick up a bit next year. So is the consumer feeling the pinch yet?
Yeah, I thought the most interesting thing, I guess, from the OECD report as well was just the sense that there's going to be a delayed reaction to tariffs, that the economic growth this year hasn't been as bad as a lot of people are expecting, and that they were sort of pushing that out to next year. So they raised a few expectations, I think, this year for some of the OECD markets. Lowered a couple next year, but not as much as you would think if they were saying that impact was going to be pushed out. I think companies and markets are sort of growing through this, maybe painfully. Hard to get a clear sense of underlying impact, I think, because it's happening alongside this major technological evolution with AI. And we're looking at, again, companies spending massive amounts of money to develop this technology, to build, to buy GPUs, and that's putting a lot into the economy. even at the same time that companies in other sectors are having to sort of figure out how to deal with all these raised input costs. The US is interesting. I mean, they just revised upward the GDP growth for Q2. Now, whether that's because, again, we sort of pulled forward imports from in Q1, and then, people bought those imports in Q2 before tariffs were set to really take effect, or once they got paused. That's a bit hard to know how resilient that's going to be into Q3. But I think even though when we revised downward our advertising forecast for the US in June, we didn't go as downgraded as some others had around that time, I think we may have still even been too pessimistic. Jeff, we've been talking about that a little bit as we've been looking at the forecast and going over the numbers again for December.
Yeah, exactly. I think you nailed it. It's just really hard to kind of strip out the tariff effect because, as you mentioned, we have all this massive investment coming in on the AI front. So it's really hard to kind of extrapolate what that means. And like you said, that we still are, I think we're still probably in the early phases of it kind of rippling through the US economy. So it's just been a very tricky one to isolate and get a handle on.
Yeah, but I think the consumer, or at least aggregate consumer expenditure, has been pretty resilient in the US as well. And we talked about last week how much of that is coming from the most affluent households versus everyone else. We've also seen, I think, a couple of debt increases. I think people using buy now, pay later services, so loans maybe becoming higher in delinquency rates. So all of that has to be gauged together. Was there anything else more specifically on retail sales in the UK consumer, Nidhi?
Yeah, so recent kind of just looking at 3 months data from June to August, seeing about 1.5% year on year growth for these 3 months. Well, they quote it as hot weather boosting activity, but it's better than negative, right? And it still shows some stable spending trends, but probably not as high as earlier on in the year where a lot of trade activity had shifted based on all the tariff uncertainty. So stable rise, but I think with that said, e-commerce is definitely continuing to, have that robust growth. And I was just looking into some of the filings of some China-based players, such as Shein. In 2024, revenue nearly doubled to over £2 billion, which seems massive. In didn't double. In UK revenue went to 2 billion from 1.6 billion in 2023, and Temu UK revenue doubled from 2023 to reach about 63 million pounds. And so just the growth of these China-based online retailers shows that global e-commerce players gaining share, maybe at the expense of some local retailers as well.
Gotta love a market that gives us some good disclosures. One of the things that we're looking at right now, and there have been reports about the number of rising app downloads or users in Brazil, for instance, for some of these companies. And I am relatively sure that that is going to be off the back of massive increases in advertising investment in those markets to lessen the concentration risk of the UK or the US, sorry, for that revenue from those retailers. That I think is hard to measure in market often because companies like Meta and Google and Snap and some of those don't typically or don't always report to the industry associations that some markets use as source data. So we're going to be looking at that in a central way and trying to determine when we look at increases from Meta, for instance, anything they say about Brazil or India or some of these other markets, and parsing out, much of that is these app download campaigns from the likes of Shein and Temu as they look at their global expansion. For advertisers, what do we think that means in the UK? Is the tone, I have to say, sometimes the tone always feels a little bit pessimistic there, even though people are spending. But do you get a sense that advertisers are looking at this economic picture and factoring that into Q4 campaigns, holiday campaigns, plans for media allocation for the rest of the year?
I think, as I said, uncertainty is the buzzword of the year, I feel. But with that said, if you look at some of the economic data, right, it's not completely extreme yet. It's stable. We know that like economies like UK, Europe, and some other markets as well, right? they're due to have this kind of period of stable growth, especially after, the pandemic where a lot of the retail boom has happened. So a lot of caution from the consumer perspective. From an advertiser perspective, I guess it's a lot as well, with the upcoming budget as well, and how that could maybe weigh on consumer confidence, especially if we have more tax rises. We've had kind of increase in unemployment figures as well, or of productivity from a business perspective as well. But as I said, a lot of advertising activity, when you look at things like inflation, look at real GDP growth, still growing. And that's kind of factored into our forecast as well of 6.5%, with some of this activity shifting from markets such as the US into the UK in particular. So I think still not a completely disastrous second half, I feel.
That's the most British phrase. Not completely disastrous. It's going to be pretty good. I'm going to
Yeah.
translate the Britishisms into Americanisms for us.
Yeah. So yeah, I mean, I'm holding my hopes high. Well, we're entering into the T1Y forecast, so we shall see as we get more data points and
Yes, we
media
are.
owner results.
Well, from the UK to all things US television, several items about really the power dynamics in US TV advertising in particular. We've new data on the Comcast spinout Versant. We have a slew of price increases for streaming services, and some questions around these often overlooked affiliate station owners in a polarized political landscape right now. But first, maybe we'll start with something a little bit lighter from the world of TV, and an announced partnership between Netflix and AB InBev.
Yeah, this was an interesting one from earlier in the week, and this, of course, is a global partnership. So, according to Netflix, it's a bringing together the world's most iconic beer brands and one of the world's most popular entertainment services. And so, it's going to be a co-marketing campaigns across a variety of Netflix popular global and regional titles. So, I think we can expect to see more and more product integration. And of course, one of the big things being is Netflix, dabbles, or I should say, maybe dives in headfirst on sports and big events. Expect to see a lot more integrations for, beer and those type of products in those shows. So I think it's really interesting. I think it's as we see this more and more often, Netflix is surely behaving a lot more like a kind of traditional US network as far as sponsorships going, a sort of an overreaching partnership to bring in products across a wide variety of programs and not just a specific show. I would imagine we're going to see a lot more of these types of partnerships, maybe for specific product categories as this business model continues to evolve.
Yeah, like I think the takeaway here is that the shift from traditional TV advertising to streaming has not been an easy one-to-one substitution, right? You have new players. It's not just Netflix and Amazon, but also LG, Samsung, Roku. The ad load is still less than traditional TV, right? So even though the CPMs in some cases may be higher, and we have seen some of that even come down in the recent past, it's not an easy one. I think some platforms are starting to creep up in terms of that ad load. But for Netflix, if they want to grow ad revenue and maintain a certain user experience, then I think more native integrated advertising is certainly a way to go. And like you said, I think I would expect other advertisers and categories to potentially look for something similar. Sizing this, alcoholic beverages are just 2% of global ad revenue about by our estimates, but AB InBev is certainly one of the biggest players in that category with $7.2 billion in sales and marketing expense last year. So definitely a big announcement from Netflix in that space.
Yeah, and I'm really interested to see how they execute this because I think as we were talking about, it's more, it just lends itself, of course, to sports. That's sort of like a no-brainer. Reality television, unscripted shows, a little bit easier, but it gets a little trickier when you're trying to place products into, more prestigious dramas or scripted shows. So
Yeah,
it's
we
going to be
joke.
interesting to see, like, especially, period pieces, or well, there probably wouldn't be anything there like there, but or like a Stranger Things or a Squid Game type of show. It's going to be it's a little bit trickier to get creative approval. So,
Yeah, we
you
joked that
know,
there's gonna be a new reality show called Beer Batter This. It's just gonna be an entire
exactly.
cooking show around beer
Right.
battering.
Right, so you could definitely see it getting incorporated that in some of the, like, the reality and the dating shows, the relationship shows, that seems, to make a lot of sense, but I wonder if we'll be starting to see characters, grabbing a beer after work or, at a specific situation more on the scripted shows.
Yeah. Brooks could have sponsored Game of Thrones and just hidden a cup in every 3 episodes and see, who can free gift card to the people who can spot
Who
where
can
the cup
spot
is,
it like a
yeah.
Where's Waldo in the background.
Yeah, exactly. All right, so from Netflix to Disney, Disney, along with several others, announced some price hikes to their streaming services. We have gone from what were, I think, some of these original prices were 4, 5, 6, $7 a month, whether for ad free or ad supported. And we are certainly climbing up now to well within double digit range. Why don't you give us a couple of the examples, and then we can talk about now how streaming stacks up against maybe the traditional cable package in the US, right? Which is always a good barometer.
Yeah, exactly. So, yeah, streaming is getting a little bit pricey here in the US. So, Disney's the latest one to announce price increases starting on October 21st. So, Disney Plus with ads is now going to be $11.99 a month, and that was up from $9.99. And Disney Plus with no ads is now coming in at $99 a month, up from $15.99. And then keeping in the Disney family, Hulu with ads is jumping up to $11.99 a month, and that's up $2 a month. And Hulu with no ads stays the same at $18.99 a month. And then, of course, you still have the Disney plus Hulu plus ESPN bundle at $29.99 a month. So a lot of different pricing out there, a lot of numbers, even for us who work in media. It's beginning to get confusing on all the pricing and the bundles and what the cost of the different packages are. But the big takeaway is it's getting more and more expensive.
Yeah, we'll put a chart in the show notes, a couple charts this week, but maybe one on some of those movements in pricing. So we did an exercise. I looked up our sort of aggregate cable average revenue. We had to look at that monthly cost for users, and then compared basically streaming monthly costs on an annualized basis. So no bundles, but just looking at the costs as they are. So if we assume cable yearly is gonna be about 1,356, $1,300 roughly, between 13 $1,400. Ad free, if you add up the costs of Peacock, Paramount, Disney Plus, Netflix, Prime Video, HBO Max, Hulu, would put you just above that at 1,379 free, but that's a very different experience than cable. So if we look at the ad supported streaming stack, all those same services, but their ad supported prices, you're still getting a hefty discount. That's still coming in at 839 versus that 1356 number for cable. Starts to look interesting. We've talked a long time about how much of what cumulatively US consumers spend on video in the US and how much of that is still held by cable and traditional and virtual MVPDs. Now, we've said streaming has room, even though people may be canceling, but it is getting back up to, again, that's the ad free version is back up to what people would have been spending on cable. Ad supported, still not there. So looking at sort of, again, equalizing that overall spend on video by US consumers.
Yeah, no, it's fascinating to see, and of course, something that just jumps out to me is just when you looking at the chart that we put together in our analysis. That I guess you could say the market roughly values ads at $500 or so, and on the streaming side, that's sort of the difference per year, per annually. That's sort of the difference between the ad-free package and the with ads, but of course, they all stream sports, and even with the ad-free streaming services, you're still watching commercials on sports, which are generally the highest in price spots and the most premium. So it's an interesting dynamic kind of to wrap your head around.
We should do like a person on the street, get our microphone and go out and ask people if they would spend $500 a year to not
Not
see
see
any
commercials.
TV ads. Just like, what's the difference between making these decisions one by one and on a monthly basis,
Right.
versus a big lump sum figure that ends up being sort of what that measures out to, right? If you do it this way.
Yeah. Yeah, I think it would be a fascinating study to see.
All right, well, we talked about the changing economics for TV and advertising in the US, especially among traditional networks. Jeff, what did the recent disclosures from Versant tell us about this? And this is the company that Comcast spun off with their cable networks other than Bravo.
Right, excluding Bravo, of course. So this was pretty interesting. Versant recently filed a Form 10 with the SEC, and a Form 10 is just basically like a preliminary filing before a security is actually listed. And Versant will be on the NASDAQ at the end of the year or early January, I believe, is the target date. So they did disclose some revenue details, which was really interesting, especially from our perspective, as we're always trying to get more and more insight on this part of the business. So the sort of the top line is that revenue has been declining since 2022. You looked at in 2022 of revenue of about 7.8 billion. 2023 they disclosed 7.4 billion, and 2024 7.1 billion. And in the first 6 months of 2025, ending in end of June, 3.4 billion in revenue. So it's kind of seeing the downward trend, which makes sense based off of their business model and on the cable ecosystem right now.
All right, and then the split, we have advertising revenue from that as well.
Yeah, we do. So then they broke down the revenue a little bit more, and then looking at advertising in 2022, that made up 2.2 billion. 2023 down to 1.9, and 2024 at 1.7 billion. And again, for the first 6 months in 2025, ending in June, looking at 825 million dollars. So again, we're trending.
Yeah, and it tells you just how we said this, how important distribution is for these channels. It still makes up the
Yeah.
vast majority of revenue. And so as those people cut
Mm.
the cord and aren't paying that $1,400 a year for their cable subscription, that really puts pressure on the distribution revenue for these cable nets.
Yeah, absolutely. And then just doing the quick analysis, about 61% of their revenue was from linear distribution, and only 24% was from advertising, and 11% was on platforms, which is basically their version of digital, and a small 3% on content and licensing. So you can see that distribution does play a big chunk in their revenue. And of course, I believe we're coming up on the end of the Comcast YouTube TV carriage feed, which should be coming up in about the end of this month. So another one to keep an eye out on.
Yeah, well, and that dynamic is so interesting when you throw affiliates in there too, right? There, it's very multi-sided network where you have the studios, some of which are also MVPD owners, and some of which also own local stations, right? But in general, studios producing content, selling that content to you know cable channel or cable providers that run it, and then also putting giving that content to local TV affiliates who, especially in the past, have really been paying to run all of that national network content and providing advertising time on their stations to do so as well. But now we're looking at, and there has been a limit on affiliate station ownership. So, and these are names that I think a lot of people outside of our world wouldn't necessarily know, Sinclair, Tegna, some of them get
Next star,
really like
yeah.
Coastal TV
Yeah.
Broadcasting owns a bunch of stations, Morris Media. There's so many like of these station owners. They have been limited historically to 39% ownership within the US, but there are pushes to relax that, especially given how much media and advertising revenue has been shifting to streaming and digital platforms. And so that's where we get into this question of Nexstar wanting to acquire Tegna, which would exceed the bounds of that 39% ownership. Sinclair wanting to add to their portfolio. Sinclair is currently already the biggest, and so we have a affiliate TV station ownership tree map as well, which we can share. Which is it's 900 different stations that like hand
Yeah.
coded in terms of ownership, and there are differences between ownership and management. But this looks like ownership for each of those, and the networks do actually own some of their own affiliates, but ABC, just for instance, has the smallest number. I think they only own about 6 to 8 of their own affiliates versus Fox, NBC, and CBS, which own a few more varying numbers. So it's fascinating world, one that we haven't looked at in a lot of detail for much of this other than tracking that revenue. And we track it especially when it comes to political advertising because local stations are still where a lot of the political spend happens. And so we look at it very, very closely every 4 years. But in terms of the dynamics of these different players, what role do these affiliate networks have going forward in terms of choosing which content they show from their national network affiliated companies and what don't they show? And is there a place where national has typically been a much higher share of total ad revenue for us in the US? Does that change with some of this? And do we see a more fragmented TV picture with more regional or local content? That's an interesting question that we're not going to answer today, but it is sort of sitting out there. And one of the big questions that I think comes from whether those rule changes do, in fact, get passed through about what station ownership could look like going forward.
Yeah, and that will, depending on how that plays out, that could, lead to even more consolidation than what we're seeing would be my guess on how that could go.
Yeah.
I'd second that for Europe as well, right? Like we're already seeing consolidation and partnerships in terms of content, especially the recent one being MFE and ProSieben.
That's right.
And MFE reported the advertising revenue declining by 1.1% for the first half of this year. And it's just, a sign that, a cross-border kind of partnership and acquisitions are likely going to be key for some of these European media owners, especially as that streaming growth and the growth of some of the largest media owners such as Meta and Google continues within the region. It's going to be increasingly important to kind of maintain that presence, not just in a local market, but across the European region.
Did they say anything about whether having the Euros, at least starting in the back half of June last year, contributed to it was like a tough comparable, or that wasn't part of um, the commentary so much?
Not so much, not that I saw, but I know other European media owners have mentioned that in the call, so suspect some of it might be to do with that. But surprisingly, Italy held quite resilient. They grew their advertising revenue by 2% relative to a market like Spain, where advertising revenue declined by just over 8%. So you'll see even a lot of contrast within the markets within the same region, which I always find very fascinating.
Why it's helpful to own multiple stations in multiple different markets, I guess, to even out some of that spikiness.
Yes,
All
risk
right.
management.
All right. Well, yeah, consolidation, I mean, can be helpful for advertisers in as much as you can have a single relationship and a single contract and coordination across multiple markets. Of course, there are also ways in which consolidation can hurt competition and price flexibility in negotiation. So, really depends on out, but something that I know, our clients and our media planners and buyers are always looking at and thinking about too. Well, one last segment for us today, I think. Let me ask you a question. What do OpenAI and Netflix have in common?
We'll probably be receiving more and more advertising dollars in the future.
There it is. Companies whose founders or execs spoke negatively about advertising in the past and later embraced it was the answer we were looking for. There was reporting from Adweek, and so I went and checked the career listings for OpenAI, their experiences across B2C and B2B segments. So that was just one of a few open roles in the growth team. Plus, yesterday they released Pulse. I haven't had a lot of time to play around with it, but it's sort of an always on push version of chat versus a pull reactive conversation. I was talking with team members here within WPP Media across our search and SEO team more broadly. We talked about this being more of a general shift in the quote unquote search world in general, right? As we move to agentic, as we move to this sort of always on push or constant sort of experience for consumers as opposed to a pull reactive. I'm searching for this one thing. I'm going to go and get this one thing. And so I think that's not the last we will talk about this or hear about this, but certainly interesting that that's what they're now in the process of building out. And obviously Instacart's Fiji Simo went there a while back. And so we're not surprised by this. We've been, when we relabeled our intelligence category to fit both search and other types of advertising within this segment, we've been expecting this. So no numbers yet. But, we talked about last week, 700 million weekly active users. That is a significant amount of reach and potentially stickiness if they're talking about having this kind of daily interaction with people for advertisers to consider going forward. Any thoughts on adding OpenAI to our table of ad sellers globally?
I think it's just a matter of time. We're getting closer and closer, so I would not be surprised if it's even as early as next year, but we'll see.
Yeah, I think I second that. I think with AI, it just happens in a blink of an eye sometimes. So it's kind of hard to catch up. But it's just also interesting that, AI kind of chatbots kind of know you better sometimes and your family or your friend. And I think that's the kind of world we're entering into, which is interesting but scary at the same time.
Yeah, well, it's interesting how much focus they put on that creative production, creative automation piece as well. So they're talking about doing that side of things. Now, Perplexity, I think, reporting in the last few months that they've scaled back some of their ad ambitions. They had primarily gone for more of a branding CPM priced option, which don't know how much of the issue that was, but I could see that being a bit of a hard sell when advertisers are used to digital being a bit more measurable, attribution focused, sort of performance cost based or outcome cost based. So I'll be interested, especially in their monetization model and what they're looking to build and how that actually gets priced and sold to advertisers. So more on that to come, I think. So that's, I think, our wrap for today. Looking ahead to next week, as Nini mentioned earlier, we are, already well into the process of our next forecast, which will come out in December. We are, in contact with all of our global markets. And so looking at coordinating with them, what they're seeing in market, what we're seeing centrally, and expectations for the next 5 years. Have more US jobs data coming out. So always busy, but we'll catch up with everyone on that next week. Thanks for listening to the WPP Media Intelligence Podcast. Don't forget to subscribe. And if you have any questions for the show, you can email us at business.intelligence@wppmedia.com. The Media Intelligence Podcast from WPP Media is meant for informational and entertainment purposes only and should not be considered financial advice.